You might have seen gold prices in the headlines, but do you know why gold has been valuable for over 5,000 years? Gold doesn't produce anything. You can't eat it. It just sits there, shiny and heavy. So what makes this metal worth thousands of dollars per ounce? The answer isn't as simple as it's rare or it's shiny. Gold's value comes from a fascinating combination of physics, history, psychology, and economics. And understanding why gold is valuable will help you understand how value itself works in our economy. Let's dive in. Section 1. What makes gold unique? Gold wasn't chosen randomly. It has specific characteristics that made it the perfect candidate for money and a store of value. First, gold doesn't rust or corrode. Unlike iron, which rusts, or copper, which turns green, gold stays gold. You can bury it in the ground for 1,000 years, pull it out, wipe off the dirt, and it looks exactly the same. This permanence is crucial. Imagine trying to save your wealth in a metal that deteriorates over time. Your savings would literally decay. Second, gold is easy to shape and divide. Gold is one of the most malleable metals on Earth. You can hammer a single ounce of gold into a sheet, so thin it covers 300 square feet. This means you can easily make coins, bars, or jewelry from it. You can also melt it down and reform it without losing any value. Try doing that with diamonds. Good luck with that. Third, gold is rare, but not too rare. Here's something interesting. Gold is rare enough to be valuable, but common enough to actually use. All the gold ever mined in human history would fit into a cube about 72 feet on each side, small enough to sit comfortably within a baseball infield. But it's not so rare that only a few people could ever own it. Compare this to, say, rhodium or other ultra-rare metals that are too scarce to function as money. Fourth, gold is beautiful and recognizable. Let's not discount this. Gold has a unique, warm yellow color that's instantly recognizable. Humans are visual creatures, and gold's distinctive appearance makes it hard to confuse with anything else. This matters more than you might think. Throughout history, people could look at gold and know what it was, even if they couldn't read or write. These physical properties gave gold a head start, but properties alone don't make something valuable. After all, platinum has similar properties, yet it's not nearly as universally accepted as money. So, what else is going on? Section 2. 5,000 years of trust. Gold's value today is inseparable from its historical role, and that history goes back further than you might imagine. Gold was a symbol of status and power in ancient Egypt as early as 3000 BC. The Egyptian state controlled gold mines in Nubia and accumulated gold as a reserve of wealth and royal authority. The first gold coins were minted in Lydia, in modern-day Turkey, around 600 BC. From there, gold spread across civilizations: Greek, Roman, Chinese, Indian, Islamic, European. Every major civilization independently decided that gold was valuable. But here's what's crucial. Once gold became money, it stayed money. Empires rose and fell. Currencies came and went. The Roman denarius, the Byzantine solidus, the Spanish doubloon, all gone. But gold remained. When Rome collapsed, people still wanted gold. When currencies hyperinflated, people fled to gold. This brings us to the gold standard era. For much of the 19th or early 20th centuries, most major currencies were backed by gold. If you had a dollar bill, you could theoretically exchange it for a fixed amount of gold. This system ended in 1971 when President Nixon closed the gold window. But for generations, gold was literally the backing of currency. What does all this history mean for gold's value today? Trust. Thousands of years of consistent value have built up an enormous amount of trust. When you own gold, you're not just owning a metal, you're owning a piece of 5,000 years of human agreement that this metal is worth something. That's a powerful foundation. Section 3. Why people own gold today. Gold serves three main purposes in the modern world. Example 1. Store of value. This is the big one. People own gold to preserve wealth over time. Unlike paper currency, which governments can print endlessly, you can't just create more gold. The supply of gold grows very slowly, only about 1 to 2% per year from mining. This makes gold resistant to inflation. When a country's currency loses value through inflation, people often turn to gold. In Venezuela, during its economic crisis, as the bolívar collapsed with inflation reaching over 1,000,000% in 2018, many citizens converted their savings to gold and US dollars to protect their wealth. The same pattern has played out in other countries facing currency crises. Think of it this way: an ounce of gold could buy you a nice suit in ancient Rome. An ounce of gold can still buy you a nice suit today. That's 2,000 years of relatively stable purchasing power. No paper currency can claim anything close to that track record. Central banks understand this, which is why they hold gold reserves. The United States holds over 8,000 tons of gold. China holds over 2,000 tons. Example 2, jewelry and cultural significance. About 50% of gold demand comes from jewelry. But this isn't just about decoration. In many cultures, gold jewelry is a form of savings. When you buy gold jewelry for a wedding, you're not just buying something pretty, you're storing wealth in a wearable form. In India, gold is deeply embedded in cultural and religious practices. Weddings involve substantial gold gifts. Festivals see spikes in gold buying. This cultural demand provides a steady baseline for gold's value. Example 3, industrial and technological applications. About 8% of gold goes into technology and industry. Gold is an excellent conductor of electricity and doesn't corrode, making it perfect for electronics. There's a tiny amount of gold in your smartphone and many other devices. Gold is also used in dentistry, medicine, and aerospace. These industrial uses create a floor for gold demand. Section 4, the power of collective belief. Here's where it gets really interesting. Gold's value is maintained by something called the network effect. Simply put, something has a network effect when it becomes more valuable as more people use it. Think about social media. Facebook is valuable because billions of people use it. If only 100 people used Facebook, it would be worthless. The network of users creates the value. Gold has a powerful network effect. People accept gold because they know other people will accept it. This is called common knowledge, information that everyone knows, and everyone knows that everyone else knows. This universal acceptance creates a self-reinforcing cycle. Because everyone accepts gold, it's valuable. Because it's valuable, everyone accepts it. The more people who participate in this network, the stronger it becomes. You can take gold to almost any country in the world, walk into a jewelry or pawn shop and exchange it for local currency. You can't do that with most assets. Try taking shares of stock or a piece of real estate across borders and converting it to cash. Good luck. Throughout history, during wars, revolutions, and economic collapses, people have relied on gold's portability and universal acceptance when fleeing countries in crisis. What makes gold's network different from other commodities? Oil is valuable, but only because people can burn it for energy. Wheat is valuable because people can eat it. Their value comes from their use, but a big part of gold's value comes from the fact that we all agree it's valuable, and that agreement is reinforced every time someone chooses to buy, hold, or accept gold. The network effect means that gold's value is self-sustaining as long as the network remains intact. And after 5,000 years, that network shows no signs of breaking down. Section 5, how gold compares to stocks and crypto. We've covered why gold is valuable, but how does it compare to other ways of storing or growing wealth? Let's start with the most common investments, stocks and bonds. Here's the fundamental difference. Stocks and bonds generate income. When you own a stock, you might receive dividends. When you own a bond, you receive interest payments. Gold? Gold doesn't pay you anything, but there's more to the story. Businesses can grow, and when they do, stocks may rise in value. A company that increases its profits year after year can see its stock price multiply many times over. Gold doesn't grow. An ounce of gold today will still be an ounce of gold in 10 years. The price of that ounce can increase due to inflation and changing supply and demand, but the gold itself doesn't produce anything or become more gold. Now here's where it gets interesting. Let's compare gold to cryptocurrency, especially Bitcoin. At first glance, they seem to have a lot in common. Both have limited supply. Bitcoin has a hard cap of 21 million coins that will ever exist. Gold's supply grows slowly through mining, about 1 to 2% per year. You can't arbitrarily create more of either one. Both are decentralized. No single government or institution controls them, and both are promoted as stores of value that exist outside the traditional financial system. Both have network effects, but they work differently. Cryptocurrency is based on blockchain, which is a decentralized network. This means no single entity controls it. Instead, a distributed network of computers around the world verify and secure transactions. Gold's network effect is different. It's embedded in people's minds. Gold is seen as valuable because everyone knows that everyone else values it. Interestingly, some projects have attempted to bridge these two worlds by creating gold-backed stablecoins, digital tokens on blockchain where each coin represents ownership of a specific amount of physical gold held in reserve. These combine the convenience of blockchain with gold's tangible value, though they're still relatively new and unproven compared to gold itself. The key differences come down to track record and stability. Cryptocurrency has about a 15-year history. Gold has 5,000 years. Bitcoin hit $69,000 in 2021, then dropped below $16,000 in 2022. Gold has fluctuations too, but nothing like that level of volatility. Conclusion: so why is gold valuable? It's a combination of unique physical properties, 5,000 years of history, practical uses in jewelry and industry, a powerful network effect where everyone accepts it, and limited supply that resists inflation. What about the future? Will gold remain valuable in an increasingly digital world? That's a fascinating question. Cryptocurrencies attempt to replicate some of gold's properties, but they lack the 5,000-year track record and universal acceptance. Some innovators have even created stablecoins backed by physical gold, attempting to combine gold stability with blockchain technology. Central bank digital currencies might change how we use money, but central banks themselves still hold gold. For now, gold's unique properties and long history suggest it will remain valuable for the foreseeable future. Whether you should own gold is a different question, but understanding why gold is valuable helps us understand something deeper: how humans create and maintain value in the first place. That's all for today. Subscribe for more content breaking down economic concepts into simple terms. Thanks for watching, and I'll see you in the next video.